Welcome to Forkast IQ. As the world accelerates into the digital economy, we're going to help you stay ahead with the latest in Web3. I'm Forkast's editor-in-chief, Angie. It's great to be here with you. All right, we're going to start off with the U.S. ruling heard around the decentralized world. XRP found not to be a security. Well, sort of. In the years-long case between the Securities and Exchange Commission against Ripple, one of the key allegations was that Ripple's token XRP was a security and therefore violated SEC laws. Well, it was struck down on Thursday by Judge Annalisa Torres in a summary judgment this week. It sent the price of XRP soaring across crypto exchanges and a roar of "I told you so's" by XRP holders. But that doesn't mean Ripple is entirely off the hook. In that same ruling, the judge said that institutional sales were considered a securities violation in that there was an expectation of profit meeting the Howey test criteria. In this case, Judge Torres found in favor of the SEC. So not complete exoneration, and the case continues. All right, from the US to Russia, major central bank digital currency developments from the world's largest country by geographical footprint. We're talking about the digital ruble here. It's a step closer to becoming a reality. The lower house of the Russian parliament, better known as the Duma, approved a law on Tuesday that will introduce the digital currency to its nation. The law is still pending the approval of Russian President Vladimir Putin, though, but once signed, it will go into effect in less than a month, on August 1st. Now, according to Russian news agency TASS, Bank of Russia will be the operator of the digital ruble platform. Non-residents will also be able to access the digital ruble through an authorized foreign banks that are participating on the platform. Now, as you may remember, Russia was hit hard by international sanctions immediately after it invaded Ukraine in February of last year, and it was hobbled by an inability to use SWIFT, the International Financial Transaction Processing System. So what efforts it will make for cross-border trade during a time of geopolitical tension for Russia? Well, a Russian CBDC gives it a lot of potential options, including allies like China. All right, speaking of CBDCs, the Bank of International Settlements, or BIS, published a survey on Monday saying that crypto assets, including stablecoins, may constitute a threat to financial stability, paving the way for 60% of central banks to actually accelerate their work on digital currencies. The survey also found that over 24 central banks are expected to have digital currencies in circulation by 2030. But the motivation for issuing CBDCs vary. Cross-border payments, efficiency, and financial stability is driving advanced economies, while in the emerging world, the need for financial inclusion is a much stronger motivation. Now, according to the Atlantic Council CBDC tracker, 130 countries representing 98% of global GDP are currently exploring a CBDC. All right, flagging this for you, it is making its way around the Twitterverse. We're talking about blockchain intelligence company Arkham. It's drawing quite a bit of attention here, and not necessarily for the right reasons. On Monday, the company announced a marketplace, Arkham Intel Exchange, that unmasks crypto entities and addresses for a pretty penny, for a bounty, riling crypto advocates and privacy right advocates everywhere. A Twitter user described the company's Intel Exchange as a snitch-to-earn program, and some even accused Arkham of leaking email addresses of users who signed up for the company's waitlist and then shared the link on social media. On Tuesday, Arkham CEO Miguel Morel acknowledged that these are legitimate concerns on how they implemented some features. And to address this, Morel said going forward, all referral links will contain an encrypted version of the referrer's email. He also refuted claims that its new Intel Exchange is a snitch-to-earn or dox-to-earn system. Arkham's Intel Exchange will go live on July 18th, but you could say it's another twist on social experimentation with technology, incentivizing, in this case, incursion of privacy, but no doubt technology will respond. Let's talk about where all of this is headed, the digital economy. As much as 10% of the world's financial assets will be tokenized by 2030. That's according to a report by HSBC and Northern Trust. Tokenization has the power to disrupt asset cycles as we know them while creating opportunities. Let's get in Henry Chong here, CEO of Fusang, to discuss all of this and more. Henry, it's good to see you again.
Thank you very much. Glad to be here.
Yeah, we're seeing a surge in tokenization. Latest data shows investors put in $600 million in U.S. Treasuries via tokenized products. What do you think? Is this the tip of the iceberg here? Will more crypto investors capture TradFi's yields here?
Being able to tokenize things like US Treasuries and other government securities is mission critical to making tokenized assets work on the blockchain. Shift into seeing something like tokenized US Treasuries to me is a clear sign that the entire market looking at tokenized securities is starting to think about again. And I actually think that 600 million US number is just the start. It's a drop in the bucket. When you look at larger macro shifts that's happening in the world today, with US interest rates being at an all-time high, there is unbelievable interest from global investors who want to buy into things like US Treasuries, money market funds, etc. And we're seeing this shift happen not just in the blockchain space. We're seeing this shift happen with things like Apple's high yield savings account, where they've started to rethink to some degree what it means to be almost like a bank. Consumers need a place to put money, they want a place to make yield, but maybe I don't actually want to take fractional reserve banking risk.
Yeah, and institutions are eyeing crypto too, right? Since BlackRock filed for a spot Bitcoin ETF, others are following suit. What potential do you think that tokenization offers companies?
It's really exciting to see both global regulators and financial institutions really focusing on what I call the tokenization of real-world assets. There's been a lot of talk about novel crypto assets, things like Bitcoin, recorded as assets on the blockchain. But I personally think that what's even more exciting is taking the shares, bonds, and funds that we see as investors every day and recording them as blockchain-based tokens. And to me, really the watershed moment for the tokenization of real-world assets came in the wake of the FTX collapse. Global banks, financial institutions, even big asset managers like BlackRock, I think now recognize that there is room for them to play in the wake of things like, the Silicon Valley Bank collapse, that actually blockchain technology makes a lot of sense when it comes to recording those assets and those securities. It's critical that we start to think about how do we fit this new technology layer of blockchain and tokenization on top of existing regulatory structures. And there's been a wave of announcement of regulators, including Singapore, Thailand, etc. And it's great to see that there's rapidly exactly this convergence happening.
Yeah, so why the sudden interest from big institutions? Do they believe in the technology, or are they simply responding to demand?
The reason why I think you see big asset managers like BlackRock moving into the space is they're responding to demand. There's a huge amount of burgeoning interest from all kinds of investors, including global banks, including central banks actually, in accessing and leveraging these tokenized assets. And I think people like BlackRock recognize that we need to offer these assets in a form where it's actually easy for traditional financial institutions to participate. A Bitcoin ETF, spot ETF, especially if managed and promoted by the likes of BlackRock, would be a landmark event for the crypto industry, exactly because it means that now the entire world of brokers who are used to buying listed ETFs in places like NASDAQ can buy this Bitcoin ETF like they would any other.
All right, let's move to the other dominant blockchain here. We're talking about Ethereum, of course. Staked ETH now accounts for 20% of the total supply. What role do you think that is going to play in creating an ecosystem for tokenization?
Ethereum has become the dominant public blockchain in terms of recording all kinds of assets, whether these are tokenized securities or even novel cryptocurrencies. I think there's a huge amount of development work that's gone into Ethereum, and there's a very powerful ecosystem surrounding it. But the question remains, can people use Ethereum as almost this base blockchain compute layer and then start to build interesting networks on top? Because the technology layer of blockchain and tokenization, that's important, but it's not enough. for us to be able to practically transact over tokenized securities and other real-world assets, we need to be able to bring online all of the existing ecosystem players that you see in TradFi today.
And let's talk about NFTs. Non-fungible tokens have been the natural introduction to digital assets for retail investors, the data wrapper for physical assets. What potential do you think that NFTs hold for tokenization?
And the concept of being able to encapsulate ownership rights, legal rights over an asset into something like an NFT token, so that I can now start to, as I said, trade this token around or easily transfer this token between people, and maybe even think about how I can start to use this as collateral to back other activities. That is absolutely fascinating. And again, to me, the current use cases of NFTs, just like of many crypto native tokens, really are just breaking the surface as a proof point of what's possible.
Henry, as usual, thank you so much for your time and thanks for joining us today. Great insights there. All right, time for a quick break, but we will check in on the NFT markets when we return. Stay with us.
Forkast.News is your gateway to all things blockchain, breaking down and breaking through the noise with the people who know it best and why it matters. We go to where the action is, from Asia to the world. Forkast is the most reliable source of intellectual discourse and insight that informs, educates, and bridges the gap between the blockchain industry and the mainstream. The future is being built, and Forkast has it covered. This is Forkast.News.
All right, welcome back to Forkast IQ. Thanks for staying with us. Blockchain gaming got an old school facelift this week, with Japanese gaming giant Sega partnering with social media platform Line Corporation, huge across many parts of Asia. Sega will license one of its classic, immensely popular game IPs to Line next to create a Web3 game on Line's blockchain gaming platform, Game.C. Now, the specific title, the specific IP, well, it hasn't yet been confirmed for the time being, but the partnership announcement does come after Bloomberg reported that Sega would withhold its classic franchises from blockchain-based gaming projects. In a statement sent to Forkast, Sega co-chief operating officer Shuji Utsumi said the company's strategy around blockchain had been misconstrued. He said Web3 technologies such as blockchain and NFTs are functions that the company will continue to explore as a way to grow its business and expand the potential of its IPs. All right, good clarification there. All right, let's find out what else is moving in the world of NFTs with Forkast Labs data analyst Yehudah Petscher. Yehudah?
Thanks so much. Great to see you again. Another pretty wild week in NFTs. The Forkast 500 NFT index reflects, well, another week of declines. And I see very little on the horizon that may turn this market around, especially with the momentum it has behind it. For now, though, I see prices continuing to fall much further. Traders are realizing that last week's recovery is, or ultimately was, pretty short-lived. So last week, we saw floor prices across NFT collections on Ethereum recover double-digit percentages. Collections like Azuki recovered 14% of its floor price in a single day. Mutant Apes 12%, CloneX 14%. These were short-term bounces after the same collections had fallen by 20 to 50%. And some collections like Beans and Azuki fell 60 to 70%. It was a full-on crisis in the NFT markets. All of this stemming from the Azuki Elementals mint. So if it seemed like that mint had a disastrous effect on the rest of the market, it did. But Azuki's not really to blame here. It was just the catalyst for a market that was already trending down. Last year's NFT market peaked on January 20th. This was actually the all-time peak of NFTs. It was the peak of hype. It was the peak of prices. This is when the masses were just flooding to the blockchain and trying to take part in something that, well, was making news. This was the mainstream mass adoption event. And over the rest of last year, the NFT market lost nearly 88% of its total value. But by this time last summer, the market had already lost 73% of its value. So coming back to this year and to our peak on January 17th, well, from then till now, we have lost 46% from our high point. Huge number, right? But nowhere close to that 73% we had lost by this time last year. So what's the difference here? Well, the thought is that NFTs are starting to find their real value or their real floor prices, and that is true to a degree. But the bigger factor here is the Blur marketplace and its incentivized listing and bidding. And most might argue that it's Blur's incentivized trading that's been driving down prices, but I don't see it that way. When you look at the Forkast 500 index and when you zoom out, you see that downtrend was already here, that it again started much earlier in the year, but also that it was much more drastic last year. So Blur's incentivized trading is actually keeping these prices afloat more than it's driving them down. Some of these traders for season 1 made millions of dollars, so you can understand why they're so motivated to do these wash trades, to participate in this incentivized trading. Now, back to this market, consider how low NFT prices could have fallen after the Elementals mint if wash trading wasn't here to inject volume and to inject liquidity into the market. Most of the top collections fell 20-25%, some of them much more. That's with over $645 million in wash trading adding volume to the market. By the way, our index filters out those wash trades. Legitimate trades do take place, though, between those wash trades, and that's what we're measuring. It's those legitimate trades. So while wash trades may add some padding, it does add some of that extra volume. There are plenty of legitimate trades happening in there, and again, that is what the indexes are reflecting here. Wash trades, by the way, yes, still a very large part of NFTs. It's keeping the NFT market actually pretty darn active. Over 62% of Ethereum's total sales in the past 30 days were wash trades. And that's $645 million in wash trades. That's more than double the top 9 competitor blockchains NFT sales combined. As far as what can turn this market around, here's one that I mentioned last week. It's a top 25 NFT project called the Cyberkongs. They have a NFT mint coming supposedly in July still. We'll see what they've learned from the Azuki mint, right? It's a tough nut to crack here, trying to figure out how to raise funds in the thick of an NFT bear market. And after that pretty disastrous Azuki mint, well, are there traders left who are willing to roll the dice on another new, potentially really pricey NFT after they were just burned by that last drop? Also on the radar is the end of Blur's Season 2 farming. Will that be the end of rewards on the Blur platform? Potentially also the end of wash trades, which again, it's adding so much volume to the NFT markets. Or will they instead kick off Season 3 with new rewards, injecting excitement, injecting fresh liquidity back into the NFT market? We'll find that out in the fall. They've not provided a date yet, but indications are that it's coming here within a few months. So we're not going to have to wait long for that. We won't have to wait too much longer to see what's going on with the Cyberkongs and again with traders. How are they going to react to that mint? So a lot of interesting stuff coming up. Can't wait to dive into that with you. That is, though, a wrap this week. I will see you again next week.
Yehudah, always love those insights there. Thanks for breaking it all down for us. Appreciate it.
Forkast.News is your gateway to all things blockchain, breaking down and breaking through the noise with the people who know it best and why it matters. The future is being built, and Forkast has it covered. This is Forkast.News.
Welcome back to Forkast IQ. Geisha, tea ceremonies, pagoda shrines. What did that kind of remind you of? And now crypto? Yeah, we're talking about Japan. It's a home to a mix of deeply traditional culture, but also some of the world's most advanced technologies. And this past month, the country hosted the Japan Blockchain Week, an extended weeks-long showcase of all things Web3, which was held in the ancient former capital of Kyoto. We sent out Forkast's Will Fee to check out all the action from the ground.
From June 28th to 30th, shrines, temples, castles, you name it, became the site of a whole array of Web3-themed talks and exhibitions as Kyoto played host to the IBS Crypto 2023 conference. The event brought together some 10,000 members of the global crypto community, including 2,000 attendees from overseas. Kyoto is known not only as a tourist hub, but also as a hotbed for academic research, learning, innovation, and a burgeoning startup culture. With that culture now updated to include crypto, there was a definite sense throughout the Kyoto event that Japan is now very much open for Web3 business and the exploration of possibilities presented by blockchain technologies.
We want to have more startups overseas coming to Japan and maybe moving to Japan. At the same time, in the future, what the government wants to see is what is called Society 5.0. where the physical space and cyber space is highly integrated, and also people's lives are more convenient or efficient by technology.
The government's crypto czar, Masaaki Taira, is a vocal proponent of blockchain technologies as a means of tackling the nation's ongoing socio-economic problems, such as the aging population crisis, extreme social withdrawal or hikikomori, and regional depopulation. Those initiatives also enjoy the support of Prime Minister Fumio Kishida. However, there are those well-versed in Japanese business that believe statements in support of Web3 from inside the government may not necessarily translate into practical action on the ground. Japan has one of the tightest crypto-related regulatory frameworks in the world, and while that has proved beneficial for protecting investors in the wake of recent turmoil in the crypto industry, it also works to stifle innovation, with the effect that even the nation's own bright young Web3 developers tend to choose friendlier jurisdictions such as Singapore and Dubai as a place to set up shop.
Japan has created a very big wall, I would say, in order to prevent normal companies from getting there. I think the main goal actually for the regulators is to make sure that only very large companies will manage to run exchanges, so there is less risk of something going wrong. But at the same time, it means that smaller companies cannot compete in this sector, which is not great.
So, can the government move with enough speed and agility to attract the global Web3 community, including its own brightest entrepreneurs and developers, to move their operations to its shores? First, it will have to find a way to make the current taxation system more attractive. The government began that process when it announced on June 20th that it would no longer charge around 35% capital gains tax on unrealized profits for tokens issued by crypto firms, a major stumbling block for the industry previously.
The positive point of Japan is that the regulation is very clear. It's about the law. But the negative point of the Japan is not the law. It's about tax and accounting. Paying tax is not the problem, because when we make the profit, we should pay tax. But we don't want to be bankrupted because of the tax.
With Japan Blockchain Week winding down, conversations around tax and regulation will likely continue for some time yet. Can Japan build on its signaled desire to open its doors to Web3 with meaningful reform and tangible effects on the ground? Watch this space to find out. In Tokyo, Japan, I'm Will Fee.
Arigato. Will, appreciate that very much. And now a sneak peek just for you, our Forkast IQ viewers. Thank you so much for this. As we put the finishing touches on the latest episode of Word on the Block, got to share this with you, and I want to do that because I sat down with the CTO behind the largest US pegged stablecoin in the world. We're talking about USDT. After that peg went a little haywire in the secondary markets. On June 15th, USDT, the largest stablecoin by market cap, temporarily lost its dollar peg, and that triggered a lot of redemptions. A run, if you will. What was the reason for that? Could it happen again? And what's next for Tether, the company behind USDT? We got to sit down with Tether's CTO, Paolo Arduano, who called the incident a good stress test for the company. You called the DPEG a good stress test for the company, but still, that was a scary time during a time where the industry really shouldn't or wouldn't want to invite that type of concern. What was that instance where it did DPEG, and how do you internally look at creating a position where stability is maintained and preventing that from happening again?
If we always maintain and we always honor every single redemption at $1, then the market is stable. So as a stablecoin, we cannot control the secondary markets. The secondary markets are all the cryptocurrency exchanges that are using USDT as their main liquidity source and as their dollar. But on these exchanges, you can find short sellers, you can find people that are speculating, you can find every type of person, and they can, the crypto industry is still young, is still small. So when there is FUD, when there is uncertainty in the market, you always find people that are trying to leverage these events to create panic. The crypto industry is like a small town, right? It's a small Italian town where you spread few words and everyone panics.
Tune in to the next episode of Word on the Block that comes out Monday to find out more. You don't want to miss it. Well, that is a wrap for us on this week's show. Thanks for tuning in, and always appreciate spending time together here. Remember to like and subscribe to this video if you're watching us online, or stay tuned right here on this channel if you're watching from home or wherever you are. I'm Forkast Editor-in-Chief and your host, Angie Lau. Thanks for watching. Forkast IQ, get intelligent in Web3.